A historical perspective is helpful for understanding the economics of clearinghouses and their implications for financial stability. The first important clearinghouse in the United States, the New York Clearinghouse, was founded by New York City's commercial banks in 1853 to streamline the clearing and settlement of checks. By one account, before the New York Clearinghouse was set up, the clearing and settlement process involved employees from 60 banks crisscrossing each other's paths through the city streets to present checks to other banks, a time-consuming process filled with, quote, confusion, disputes, and unavoidable blunders, unquote. The establishment of the clearinghouse improved the situation almost immediately, resulting in significant savings in time, effort, and financial cost. By the late 19th century, check clearinghouses have been established across the United States. Large segments of the financial system came to rely on the efficiency and integrity of the daily settlements by the clearinghouses. Indeed, as these institutions developed, the role of clearinghouses and clearinghouse associations, the groups of firms that used and supported individual clearinghouses, went well beyond purely operational functions. In the years prior to the establishment of the Federal Reserve, to increase public confidence in banks, clearinghouse associations at times took on quasi-governmental supervisory functions. For example, by examining the financial conditions of banks rumored to be in difficulty, and even serving at times as lender of last resort to individual clearinghouse members. In the securities and derivatives markets, the story unfolded a bit later and was more complex than in the case of checks. Nevertheless, many of the essential themes were the same. In 1892, on the centennial of the famous Buttonwood Agreement, the New York Stock Exchange took its first steps to improve clearing and settlement by creating a clearinghouse for limited types of brokers' trades. Faced with growing volumes of trading and the associated clearing costs after World War I, the New York Stock Exchange took a further step in 1920 by establishing the Stock Clearing Corporation. This new clearinghouse reduced the number of checks needed for settlements by up to 90% and the volume of funds and credit needed by 70% or more. It was not until the dramatic increase in equity trading in the late 1960s, however, that the backlogs of trading tickets, confirmations, and delivery instructions caused the famous paperwork crisis that led the exchange to curtail trading hours and close on Wednesdays for 6 months in order to manage the situation. The paperwork crisis represented more than a set of operational problems for financial institutions and other market participants. Unprocessed instructions and delivery failures also increased the financial risks faced by many firms, leading to supervisory concerns about the ability of firms to control and monitor their securities holdings and exposures and to manage their financial positions appropriately. These risks clearly needed to be addressed. Pressed by the Congress and regulators, the industry began in the mid-1970s to establish central securities depositories and central counterparties, known as CCPs, to immobilize paper certificates, encourage multilateral netting of trades, reduce pre-settlement risk through the guarantee of trades, and conduct security settlements through book entries to electronic records. The result of these efforts was a set of critical electronic infrastructures to centralize and coordinate clearing and settlement, including the establishment of CCPs to provide settlement guarantees and reduce counterparty risk. The market for government securities saw reforms as well, following the failures in the early 1980s of several smaller government securities dealers and increasing concerns about the integrity of clearing in the government securities market. In 1986, authorities and market participants developed a CCP for over-the-counter government securities trades to augment bilateral clearing, which at the time was the dominant practice. Today, this CCP is part of the Fixed Income Clearing Corporation, a subsidiary of the Depository Trust and Clearing Corporation, known affectionately as DTCC. In the case of exchange-traded derivatives, the significant benefits of clearinghouses likewise became apparent over time. The Chicago Board of Trade, now part of the CME Group, was established in 1848. After various experiments to manage the paperwork associated with growing trading volumes, the CBOT established a clearinghouse in 1883. Although the role of the clearinghouse was initially limited, it significantly reduced back-office work and the amount of funds and credit needed by its members. In 1925, the members of the CBOT set up a full-fledged and independent central counterparty, the Board of Trade Clearing Corporation, now called the Clearing Corporation, to provide the guarantee and settlement functions that are so familiar today. Risk management tools such as margining systems and default funds were adopted to backstop the guarantee provided by the clearinghouse. The use of CCPs for exchange-traded derivatives continues to evolve. For example, a new CCP that combines the clearings of futures on Eurodollars and U.S. Treasury securities with positions in fixed income instruments, called New York Portfolio Clearing, was launched in March. As clearinghouses developed, their resilience, in particular, their ability to manage their liquidity and ensure the integrity of transactions under stressed conditions, was tested by financial shocks and crises. I'll briefly discuss three historical episodes that tested the financial infrastructure: the financial panic of 1907, the 1987 stock market crash, and the recent crisis. Although the clearinghouses of the time survived all of these episodes, in each case the problems they faced demonstrated potential vulnerabilities and a need for reform. More generally, these episodes warn us to remain vigilant and to guard against complacency. Complexity and change in the financial system will continue to present new challenges to stability as they have in the past. I noted earlier the development of clearinghouses for checks in cities around the country in the second half of the 19th century. In the financial panic of 1907, which involved depositor runs on banks and trust companies in New York and elsewhere, check clearinghouses struggled to obtain the liquidity that they needed to complete daily settlements. To avoid settlement failures and to address a wider need for liquidity, including liquidity being demanded by the anxious depositors of troubled banks, many clearinghouses followed a practice that sprang up shortly after the founding of the New York Clearinghouse. Specifically, members of the clearinghouse as a group issued collateralized loans in the form of so-called clearinghouse loan certificates to those members that were short of liquidity needed for settlement. In a real sense, the clearinghouses served as a private sector lender or liquidity provider of last resort. Some clearinghouses even issued small denomination certificates that circulated widely outside the clearinghouse as a substitute for currency. Although these measures were helpful, demands grew for public action to address the problem of recurrent panics. These demands ultimately led, of course, to the formation of the Federal Reserve in 1913, in part to act as liquidity provider of last resort, as well as to strengthen the supervision of state-chartered banks. 80 years later, the 1987 stock market crash provided a market-wide test for securities and derivatives clearinghouses, as well as their members, banks, and related institutions. Surging volumes of trades and extraordinary price volatility during the week of October 19th created errors and delays in confirming stock trades, severe operational and financial stress at clearing members, and heavy liquidity demands throughout the financial markets. In the derivatives markets, multiple intraday margin calls were made to protect the clearinghouses, but banks sometimes delayed making key payments to and from the clearinghouses, adding to the uncertainty. Meanwhile, the clearinghouses themselves apparently absorbed significant amounts of intraday liquidity from the markets by collecting but not always paying out so-called variation margin, payments that investors were required to make as the value of their holdings plunged. In reviewing the episode, the Brady Commission noted that although the clearinghouse system had avoided defaults, investor uncertainties about the viability of the clearinghouses, as well as about the ability of major broker-dealers to meet their obligations, intensified market fluctuations and panic. In response, the public and private sectors worked together to address the weaknesses that had been revealed, for example, by clarifying the obligations that clearinghouses, clearing members, and settlement banks must assume, and by bolstering the liquidity and security of the financial resources held by clearinghouses. In 2008, clearinghouses and their members were again tested by significant financial shocks, both in the United States and abroad. Although the events of 2008 were not centered in equity-related markets, the measures taken after 1987 no doubt contributed to the resilience of clearing arrangements in the securities and derivatives markets. The official sector support arrangements for financial firms and markets, including the Federal Reserve's discount window lending and special liquidity programs, also indirectly eased liquidity pressures on the clearinghouses. In the global foreign exchange market, CLS Bank International, a system that began operating in 2002 with the purpose of addressing settlement risk, is widely credited with maintaining confidence for continued interbank trading and settlement of foreign exchange. Overall, the historical record shows that clearinghouse arrangements have generally withstood even severe crises. This solid performance reflects good planning and sound institutional structures, but also some degree of good luck, as crises have also revealed important vulnerabilities. Vulnerabilities which prompted subsequent reforms by both the private and the public sectors. Clearly, if we don't want to put all our trust in continued good fortune, we'll have to continue to be proactive in identifying and remedying weaknesses in these critical infrastructures.